everyone. Here we are again. It must be Wednesday, and we've got Lexi here today to do the questions and to make it a couple rather than a single. Another big week in property. We've got some interesting news today, Lexi. We're going to have a look at the latest house building costs through the My Housing Market House Building Cost Index. Not a lot of good news there. We've been hearing that, the ABS and others have said that maybe we're continuing to see house building costs ease. Of course, we've seen them go through the roof, if I could use that analogy, over the last year or so. But they've certainly come back from the peaks of last year, but in terms of annual growth of costs. But they seem to have levelled out, which isn't good news, because they're still well ahead of where they were before COVID and before that stimulus package that the previous government introduced. So, just starting to level off and at a pretty high level still, which isn't good news for those, firstly for those wanting to build a house because, you're going to have to cover those extra costs. And, that it might be looking to be entrenched now, and it's because these things people just, builders, tradesmen, suppliers tend to just think, well, if that's the level of increase, then that's what we've got to do in our contracts. And it becomes embedded, that sense of how high prices have to rise every year. Now, it's not just a problem for the industry, it's also a problem for inflation because, that means it sort of keeps an upward track on inflation, although inflation is the measure of growth from period to period. So if it just sticks at, double-figure growth, well, it's not going to change much, but it still means that that's what you've got to pay every year extra, for a new house. So we'll look at that data. Also, we've got the regions, which we show here from time to time. So we'll look at very exciting. I can tell you're excited, Lexi, but so we have to look at the
always dog.
We have to look at the regions, and we look at the major regions, and perhaps there's not a lot of regular coverage in terms of what the major regions are doing, but we have it here, and we're going to look at it today. Yeah. We've got a lot of data coming up this week, a lot of important data. We're going to show the house building costs, and we're going to show a measure which we've shown you before of just to sort of, revisit that process of comparing approvals for houses, building approvals for houses with building commencements. And just to make the point that this is one of the problems that we have with high building costs is that we don't, even if we're getting the approvals, and as we've discussed here, plenty of times approvals are pretty low and they're way below their previous peaks, house approvals, unit approvals. If prices are rising, it makes it even tougher for builders to sort of turn the approval into an actual commencement because they won't do that, of course, until they know they're going to make a profit. And we've seen that with a recent chart that My Housing Market has put together is showing that there's becoming a bit of a gap between the level of approvals, which they normally are compared to commencements. And that maybe means that higher building costs are keeping those approvals from becoming commencements. Now, today, and the data on commencements is a little bit backward looking. The latest data that we have is March quarter, of course, which is 6 months ago. But today, the ABS are going to release the June quarter data for commencement. So we can see if that trend is continuing. So we might have a look at that next week just to see if that trend is continuing. And, of course, the big picture here is that it's more bad news for particularly tenants because it means we're not resupplying or supplying our housing markets at the level we need, particularly given this surge in migration that we're seeing. I think there was some data released last week that showed that so far this year or over the past year, which is basically so far this year, we've had over 500,000 migrants coming into Australia. So, every one of those needs somewhere to live, of course. So that sort of which gives you a sense of just how tough the market is and why rents are continuing to rise and why vacancy rates are at very low levels. So we've had a big intro here, but just a bit of background on the data. But we will get that latest commencement data out today from the ABS, so we'll have a look at that next week. And we get the labour market data out for September, which is the first set of data that we get on a monthly basis for the previous month. So we get the labour, the results for the September labour market. So that'll be the unemployment rate, et cetera.
Yes.
And of course, we know it's been a marvellous labour market, really, without pausing, have taken a breath. It's just been super strong and probably the strongest labour market, we've ever had. And of course, that's helping us to, to some degree absorb higher interest rates. And it's what's, also contributing to, reasonably positive consumer confidence. And so that's all good. So I guess we should get started before I run out of breath or spit or something like that. So this is the latest data for this week for My Housing Market. And, of course, My Housing Market is an independent provider of commentary through myself and data. We have our own data sources. So, we act as an independent, providing independent insights into the housing market. And most importantly, and we do that in our podcast every week, it's about the current state. So obviously on a week-to-week basis, we bring you all the latest information on the housing market, and not just prices and rents, but all the key drivers behind housing market activity. And because that's important to understand the background to what's happening in the housing market, and that's all about those future prospects as well. So just a little bit of an ad there for My Housing Market. So we mentioned house building costs, and this we'll start off with today. So national quarterly house building costs increased again over August, according to the latest data from the ABS, and remain significantly higher compared to the same period last year. And if we look at the chart, this is the My Housing Market Index for house building costs, and you can see how it just sort of, as I said, went through the roof from the beginning of 2022. We've just seen this incredible increase, which was due to the home builder allowance, which was introduced by the previous government, and that was all about a stimulus package for COVID. Of course, we're all pretty worried about what COVID was going to do, and as usual, governments, and rightly so, head to the property industry, the construction industry, the home building industry to help them out in terms of increasing economic demand. And that's what happened. But unfortunately, we created it's problematic. We created the demand, which has kept our economy ticking over, but we also created so much demand that supply couldn't catch up. We
couldn't keep up with it. Yeah.
Couldn't keep up with it. So we didn't have enough tradespeople. We didn't have enough supplies. And that meant that, costs, as you can see there, just skyrocketed. And that's just, unprecedented. And as I said, the problem is that even though we're starting to see a levelling off, it's, because obviously supply is starting to match demand. Although, we've got all this extra demand coming from offshore, it's still, very, very high. And it's interesting when we look back, Lexi, before that stimulus package, you can see how steady house building costs were, And when we look at the growth rates shortly, you can see the growth rates obviously were way below where they are now. But the thing is how steady those house building costs were. And that's important to understand because it's a very competitive industry, house building.
Yes.
Profits, builders typically work on low margins or lowish margins, and they can do that because building costs are typically reasonably steady and certainly subdued to what we've seen over the last couple of years. So I think that's important to know. And you see, home builders will typically offer a fixed price contract for your house. So this is how much it's going to cost, right, by and large. So Whereas in commercial, which has a longer time frame, of course, for a start, you typically get a rise and fall contract. So, the contracts can be adjusted for changes under particular circumstances, for changes in costs. But it's looking like, if we have these sort of higher prices, we may have to start rethinking the building contracts, that we can't really do fixed term contracts, and they might have to be sort of rise and fall contracts. But all this does is it means, fewer, as we've discussed, fewer houses. Just when we need so many more houses, we've got these roadblocks, and it's not just the roadblocks that have kept new home building under wraps for the past 5, 6, 7 years. It's now something else, which is high building costs. And we discussed that in relation to, which we'll look at the chart in a minute, in relation to commencements versus approvals. So when we look at that's the actual chart of the index, but when we look at the annual growth of national quarterly house building costs, we can see that that's steadied over August. But that's been falling, and this is the problem. It looks like it's now forming a sort of a base at high levels. It's not falling as it has been, which will continue to place pressure on the profitability of home building. So that's the annual rate of increase. And you can see there that, again, pre-COVID, the rate of increase was, under 5%, and it certainly was quite steady, but at a lower level there, which meant that you could pitch, builders could pitch a fixed term contract because they sort of understood where their extra costs would come. But since, with that stimulus package, the annual rate of growth has gone through the roof. And at one stage there was nearly 25% increase over a year in house building costs. So how do you cover that? Well, you don't. But it has fallen, and it's been falling quite sharply until recently, and that was the hope and perhaps the expectation. Of course, this works its way into higher inflation generally, so it's not good news for the RBA and for those that are, obviously looking for lower interest rates or not higher interest rates. But, we can see that it's just sort of plateauing there, the annual growth rate. It's at 11.5% over August, which is similar to the last 2 months, the previous 2 months. So not good news there, that we're looking at, maybe that the annual growth at a high rate, still double figures, is now, entrenched at that level, which makes it, which will make the new, because that's what tradesmen and, suppliers, tradespeople and suppliers will expect, is that, okay, we've just got to put 10% on everything going forward. So it just becomes part of, the sort of entrenched position in terms of increases in costs. And then the consumer's going to have to say, well, I've got to pay an extra 10% now, and I'm paying this extra anyway with high inflation for a lot of things. So that means they're going to be looking for higher wages. So we sort of, we're still in that inflation loop. As I said, at the moment, there's no real joy for continuing to see what was hopefully going to be going back to our pre-COVID levels of house building costs. So, not good news there. It's steady at 11%. I guess we need to hope that will start to fall back to those pre-COVID levels and resume the downward slide, but still a very high level there, and a historically high level in terms of the pre-COVID environment. So I just showed you what that stimulus package did. It certainly was positive, and you can't argue against, what we needed to do during COVID. But here we go. How long are we going to have to put up with the sort of the side effects from it? And that's that chart I was talking about. So this looks at building approvals versus building commencements. Now, typically 3 to 6 months between a building approval becoming a commencement. So if we move forward our commencement, our building approvals to match commencements by 3 to 6 months, which we've done here, it sort of shows us a real comparison in time. And if you can see the longer term journey there, it's pretty much the same. the level of building approvals and building commencements. So that shows you that it's sort of in sync. But if we have a look at the very, very end of that chart, we can see there that it's just starting to fall away because the bar chart there is commencements and the black line is approvals. You can see how that gap is opening up. Now, it picked up a little bit over the recent period, but that was because we had a big period of approvals. But having said that, when we get the June data, which is out today, for commencements, it'll show us whether that's continuing. Now, let's hope it's not, because if it does continue, it's showing us that we've got this problem with builders turning building approvals into actual commencements, which only means that we'll get fewer homes coming into the market, new homes coming into the market, just when we need, tons and tons of new homes coming into the market to satisfy skyrocketing demand. So we mentioned we're going to have a look at the regional markets. So let's have a look at the top regional markets, how they've performed over the September quarter. So one of the issues that we have, and these are local government areas, firstly we'll look at New South Wales, we'll look at the median, we'll look at the change over the quarter, over the year and over the 2-year period. We've got one extra column in there. Look at the first column for quarter. But we can see there that the top performers, interestingly, if we go back to 2 years, it's probably best to look at what's happened over a 2-year period. We can see that the lower priced western areas of New South Wales have been the strongest performers. Wagga Wagga up by 29% over 2 years, and Dubbo up by 15%. So sort of in the same area, although, of course, Dubbo's much northerly than Wagga Wagga. But I think that's a sort of an affordability thing, because you can see there that even though they've had the strongest growth, with the exception of Albury, which has also had pretty reasonable growth over the past 2 years of nearly 10%, they're lower priced areas. And I think that's the sort of affordability advantage of those particular areas. And maybe also part of that was, and I don't want to pay too much heed to this being a reason, people leaving Sydney through the COVID lockdown periods. Or maybe people just considering, affordability is an issue. Let's look for somewhere to live where it's more affordable. And of course, Dubbo and Wagga are well serviced by the commute into Sydney. Dubbo a bit more than Wagga, of course. Wagga Wagga, of course. But maybe there's a little bit about that. It's interesting that over the 2-year period, Wollongong's been the underperformer there, down by 3.1%, and also Ballina down by 1.1% as well. So, quite interesting. You would have thought that Ballina would have been a key target for those wanting to go north.
Absolutely.
Ballina Byron Bay would have been a key target for those moving out of the COVID lockdown period. But no, it's sort of been an underperformer. By and large, the regions have done pretty well over the past 2 years. Not quite up to similar to Sydney, most of them, but they've done pretty well, with the exception there of Ballina. So that's New South Wales. Let's have a look at Victoria now. Sort of a similar position there with the lower priced areas. Bendigo, and we're looking at the 5-year period, up by 5%. Results here are a lot more subdued than we saw in New South Wales. Just down a little bit, Bendigo over the past quarter. Latrobe, again, similar to New South Wales. That's the most affordable of these LGAs. Latrobe, of course, out to the east of Melbourne, up by 15%. Again, maybe a little bit of that exodus out of the lockdown in Melbourne, heading towards more affordable areas. Latrobe, and I think also, even though Macedon Ranges certainly is a higher priced region, I think that there's a little bit of that exodus out of Melbourne as well into the Macedon Range, which of course is adjacent really to the Melbourne metro area to some degree. But it's also had a near 10% increase in its median price over the 2-year period, and continuing to grow up by 7.7% over the quarter so far. And another one, which is probably a little similar to the Macedon Ranges, because the Macedon Ranges is north of Melbourne, is the Surf Coast, which is southwest of Melbourne. And that, of course, is quite a high-priced area. And there's a real sea change shift, because that's a coastal area down to the Surf Coast. And I think that would have been accentuated through the sort of the lockdown period. But it's up also by 6.7% over the 2-year period and continuing to grow up by 1.7% over the quarter. But, look at the median. The Surf Coast median there is, over $1.2 million. And it's certainly a property, an area which is defined by a shortage of property and high demand. And that's one of the key drivers there for the Surf Coast. So we'll have a look at Queensland now. We keep repeating this same old scenario, that it is generally the lower priced areas which have done well in Queensland. And, I think that, there's been tremendous value in some of those, particularly coastal areas north of Brisbane. And no surprise, we've seen a massive rise in Bundaberg for a start, up by 37% over 2 years. Fraser Coast, which of course is north of Bundaberg, up by 34.9% over the past 2 years. And Toowoomba has been a real superstar.
Yeah.
And of course, that's probably maybe a little bit about the COVID scenario, which I think drove the Fraser Coast and Bundaberg, those looking for, a sunny, seaside environment to get out of the Brisbane, COVID issues. But Toowoomba, maybe a little bit of that too, up by nearly 40% over the past 2 years. Really, that's a boom market, and continuing up by 2.1% over the quarter so far. So again, that sort of affordability scenario working its way into higher prices, as well as perhaps that the COVID exodus environment as well. Just a shout out there most of the regions in Queensland, in fact, all of them recorded growth over the past 2 years.
Yeah.
So very strong results there, really across the board. And everywhere except the Sunshine Coast recorded double-figure growth. And yet north of the Sunshine Coast in Noosa, which used to be part of the LGA of the Sunshine Coast, but now it's its own LGA, it's had strong results when you put them together. That gives you a sort of an average of over 10% anyway. But, Queensland really did lead the charge in terms of its, larger regional area performances over that 2-year period. And, and as I said, affordability, lifestyle, I guess, and also the issue to do with Southerners moving up during that COVID lockdown period. So let's have a look at a couple of our smaller states' performances. We've sort of mentioned that Hobart's been a little bit of a non-conformer. We've had strong growth, or certainly positive to strong growth, in most of our capital cities this year, with the exception of Hobart. Now, even though Hobart's showing a good result there over the quarter, this is the Hobart local government area, not the Hobart capital city area. So we need to sort of make a differentiation there. And that's why these results perhaps are a little stronger, being a smaller market area over the quarter than the capital city results for Hobart, which have been moving backwards this year. And Hobart does tend to be a little bit of a non-conformer. When other capitals are rising, it tends to fall. When other capitals are falling, it tends to rise. But, all you have to do is look at the median there for Hobart, which at 864,000 shows that there's been plenty of growth in that Hobart LGA market over the past few years. And, that LGA result is, on a level with the capital city LGAs, So no surprise that we have seen some easing, but down by 12.9% Hobart over the past 2 years LGA, which is sort of similar to what we're seeing for the Hobart capital city. But the best performer in Tassie has been Launceston, where we've seen prices up by 4.5%, but a bit of a subdued performance in those major Tasmanian regions, Lexi, compared to the other capital city, or the other, state major regions. When we look at the Northern Territory, the major LGAs there are Darwin and Palmerston is part of Greater Darwin, of course. But Darwin's outperformed Palmerston. In fact, its median is now significantly higher than Palmerston's median, up by 6.4% over the year and 3.6% over the 2-year period, with Palmerston's been basically has remained flat. So that's our regional breakdown. It's good to see how the regions are performing.
Absolutely.
There's lower data sets there because obviously there's smaller areas, and we can't go into even smaller areas because it becomes more volatile. So over that 3-month period, it can bounce around a bit, but they're big enough here. And I only take the largest LGAs to measure here because, as I said, it gets volatile if you use the smaller ones. But I think there's some interesting trends there, particularly in terms of affordability in New South Wales and Queensland. And I think the sea change and the green change in Victoria, we're talking Macedon Ranges and the Surf Coast, is driving a lot of demand into those particular areas. And Tassie's certainly been a bit of an underperformer, with the exception perhaps of Launceston, but still Launceston's been a little flat this year so far, and Darwin the top performer in the Northern Territory, or the major Northern Territory LGA. So, as usual, we look at the auction market performance to end the show today. We've certainly seen auction markets continuing to provide reasonably positive results generally for most sellers. So we could say, it's still a seller's market, but it's certainly not as strong as it was earlier in the year. And when we look at the trends, we can see that even though it's still a reasonable market for sellers, it's not as red hot in most of the capitals as it was in late autumn, moving into winter. Now we do see that start to evolve at this time of the year anyway, Lexi, because you get more stock coming into the market as the spring selling season progresses. So there's more choices for buyers, and of course we're also in terms of the cycle starting to hit those affordability constraints, because we've got to remember we've had strong growth in most of the capitals this year, Sydney, Perth, Adelaide, even Brisbane may reach 10% prices growth this year. So that's got to be, that means that a number of buyers are starting to get pushed out of the market because of higher prices, affordability constraints. Of course, we've had 12 interest rate increases since May last year, and that eventually impedes buyer capacity. We also have general inflation, which is at its highest level in decades. So that also means it's a bit tougher to, find those extra bucks for a home. And, the savings have been largely, all those savings we built up during COVID have now largely been spent, and we're back to sort of more normalised levels of savings. And the point is that the value opportunities are no longer there as well. Sydney dropped 9% last year. So those that have been buying in Sydney were actually buying at a discount compared to prices last year. So that's sort of caught up now. So those sort of the discounts no longer really available. Sydney's still about 1% or 2% below where it was at its peak last year, but that discount driving force is no longer as strong as it was. Same in the other capitals, particularly Melbourne. Certainly Melbourne and Sydney had the biggest discounts on offer because their prices declined the most last year, and a lot of the pent up demand from last year as well. When we got the interest rates rising, of course, there was a big scare campaign through winter and into early spring last year, doom and gloom, higher interest rates. So obviously that impacts, buyer and seller confidence, and they tend to sort of sit on their hands. And then when things start to get better, as they have this year in terms of confidence, all those buyers and sellers that sort of sat on their hands, particularly buyers, start coming out of the woodwork. So a lot of that pent-up demand has been, released and satisfied.
Yeah.
So that's why that's another factor, not just the seasonal factor of a maturing spring market, but also, all those other factors that deal with affordability and the cycle are impacting our auction market. So I've gone through a very lengthy discussion on why we've got lower rates. So let's have a look at the results from last weekend. Clearance rates were generally lower. Sydney's still a bit of a standout there, Lexi. Lower auction numbers last weekend, which is, we always see settling because the weekend before we had big auction numbers, because the weekend before that we had small auction numbers because of public holidays and the football finals, all that sort of stuff. So 738 auctions in Sydney, still a good number, but down from the 800 of the previous weekend. Clearance rate was actually up in Sydney, 73%, not a bad result. Certainly below its 80% that we were getting, but again, still reflects the seller's market and higher prices. And again, higher than where we were a year ago, where we had, higher in terms of auction numbers and still higher in terms of the clearance rates. And a year ago, we were getting markets that were starting to revitalise as that confidence returned. Melbourne, 100 auctions fewer, again, still a good number. The weekend before in Melbourne, we actually had the highest number of auctions for the year so far. So still big numbers there, but the Melbourne market really has been easing recently, 67.2% result, which is one of the lowest clearance rates this year so far. So Melbourne just moving a little bit sideways and trending downwards, and still above, however, where it was a year ago in terms of the clearance rate, and also above where it was in terms of the number of auctions. Brisbane fell away, a bit more of a normal result for Brisbane. We're used to seeing those 40 to 50% results on a weekend in Brisbane, which is different to, that result would mean in Melbourne or Sydney, because it's a different auction culture in Brisbane, and it had fewer auctions as well, and down on where it was the weekend before. Adelaide was also down in terms of auctions, and a typical non-Adelaide result below 80%, where we're just used to seeing 80% plus in Adelaide weekend after weekend. So let's keep an eye on Adelaide, but I would have suggested it would bounce back next weekend, but we'll look out for that. But conversely, Canberra bounced back and was quite strong, given a low result the previous weekend with the same number of auctions coming through. So definitely an easing in the strong conditions we were used to through autumn and into winter. But again, we've sort of discussed the reasons behind that, affordability constraints, and typically we start to see higher numbers of properties for sale, and that gives buyers more choice. And a lot of buyers, have made their decisions. As I said, that pent-up demand particularly has been released that was built up last year. So that's the trend for Sydney. Still tracking pretty well there so far this month, 71.6% clearance rate, but well down on what we were recording in May and into June, which was just about at 80%. Can you believe, over the full month, which is very strong, and that's why we got over 1% per month growth in house prices during that period in Sydney. Melbourne's, the last couple of months in Melbourne have been a little bit sideways. September's always a distracted month in Melbourne because of the issues with their grand final, particularly down there. Don't want to put too much blame on that, but certainly Melbourne has been a little bit so-so compared to what was very strong again in Melbourne, particularly in May, where it was pushing up towards an 80% clearance rate. Of course, we regard 80% as being the benchmark for the boom word, a booming market, and but Melbourne certainly flattened a little bit. Bit of a surprise. I thought Melbourne would be a stronger performer this year because I think there was still some catch-up capacity because of its severe lockdown, or severe lockdowns. But nevertheless, it's still just a seller's market, just about a seller's market in Melbourne, but we'll keep an eye on Melbourne over coming weekends. Brisbane down a little bit, particularly given that weaker result over the weekend. And it too, I'm saying the same thing here, is down on its peak results in May. And anything over 50% in Brisbane really is, given the it's a different culture there in terms of auction marketing, is a reasonably positive result. And we're still seeing price growth in Brisbane generally. Adelaide, just down a bit. You can see there on what was a surprisingly low result in Adelaide at the weekend. We'll keep watching Adelaide, but as you can see there, it mainly tracks around that 80% mark, certainly has been this year. And Canberra, although we've got a bit of a dodgy slide there, okay, whatever, has just picked up over the month so far, but it's been tracking, 50s, then picked up and then has fallen away again. So it's been a volatile market to some degree this year, that Canberra auction market. So if you want those auction results, they're available every Saturday night, hot off the press, the capital city results on my LinkedIn account, Andrew Wilson LinkedIn. And also we release the Capital City National Report on Sundays, which gives a full breakdown of the Melbourne and Sydney region auction results at the weekend. So, as we always do at the end of our podcast, we're going to have a little ad here for Infinity and My Housing Market, because we talk obviously about the housing market here and prices and rents, but wouldn't it be nice if you had something, on your phone that you could go to whenever you felt like it, can't sleep, okay, how much is my house worth, right? So
I don't know if that's going to make you sleep, hopefully. Might get you excited.
It's mainly good news. So, you're right. You might get so excited it makes it worse.
There you go.
But, all right. Well, maybe you're just caught short for nothing to do. What can I do? Sick of reading the news. It's all doom and gloom. I'm going to look at that Australian housing market. So what you can do is you can get a hold of the My Housing Market mini app, and it's just a nice little mini app that you can use to tell you, and there might be a million agendas for this. You might be a landlord, you might be a tenant, so you want to know what the latest rent is, how many properties are for listed in my suburb. So this gives you the breakdown for rents and prices on every suburb in Australia, every single one that has data. So the ones that don't have any data, well, we don't have that, of course. But if there's a suburb there with data on house prices and rents, and it's asking house prices and, of course, asking rents, because that will tell you exactly what's happening in the market. And we update this every day. So you get the latest data. So it shows you what the asking price, so what all the sellers are thinking about what they should pitch their property at for every suburb. So that helps you if you're a seller. Well, how much should I ask for my price, for my house or my unit or my townhouse? So you can find out what everybody else is asking. And not only does it give you the median price, it also gives you the high price and the low price. So you can see what's high, what's low, and what's in the middle. And it's not just for prices, it's also for rents. So you can look at what the median rent is in my suburb, in the high rent and the low rent. So that's interesting, if you're thinking of renting or moving, or if you're a landlord, whatever. And not only does it give you the prices and rents, it will give you the number of listings as well. So it'll show you how many houses are for sale in your particular suburb, and it will show you how many houses are currently for rent in your suburb as well. So, and there is more. Yes, wait, there's more. No, not steak knives, but we do have more. You also can filter the suburbs for the type of property. So you can pick a house, a unit, or a townhouse. So you can filter for type of property. And you can also, hey, don't get too excited here. You can filter for the number of bedrooms. Wow. So you can go 1 bedroom, 2 bedroom, 3 bedroom. Yeah, so 2 bedroom unit,
stepping it up.
4 bedroom house. Wow, is this amazing? Or the total number of bedrooms. So that app is available. That's the QR code that takes you to the link to the app, but there is a catch here. You have to, this is available only through Infinity. So you have to go through Infinity to find out how you can get hold of that app. So I'm excited. I can tell you're excited too, Lexi. So get hold of that, that app, and because it's a really great little tool for making decisions regarding property. Yeah. And as I said, it is updated every day. So it's all the latest data. And get a hold of that one. So that was our big ad for the day. Next week, we already mentioned we're going to look at the labour market details, which are released on Thursday. That's the September, the month of September results. That's the unemployed, the unemployment rate, the number of jobs created or lost, and the level of employed and the participation rate. Just remembering we had a spectacular result in August, 3.7% unemployment rate over August, which was steady compared to July, around about a record low. We created 63,000 jobs. We lost 3,000 unemployed, a record participation rate. I guess maybe, logic tells you to some degree there might be a bit of an easing over September. Yeah. It was a holiday month. So wait and see. Interesting results from that latest ABS data, which will be released this week on Thursday, and we'll discuss it in depth as usual next week, and what its implications are for inflation generally and the housing market. We've already mentioned we're going to look at the updated house commencements versus approvals. Is that trend continuing? And we'll look at any other data that's come along. Plus, of course, the latest weekend auction results. And that auction market is certainly interesting at the moment in terms of where it's trending. And like I said, we've only got 8 weeks till Christmas. We've got 7 auction weekends left till the end of the year. So sellers will be, hey, let's hope we sell our property before Christmas. And buyers will be thinking, I might get a great deal before Christmas and
Black
have
Friday
a new
deal.
home. Yeah. Black Friday. That's right. That's coming up too.
Sure
so plenty to talk about. So I guess we should sign off there. Again, we bring you all the latest data here every Wednesday, and it's all about the current state and future prospects of your housing market. And get the app because get the app, and that'll give you the real deal on a daily basis. Does it get any better than that? Well, no, it doesn't. So thank you very much, Lexi.
Thank you,
and,
Doc.
I'll likely see you next Wednesday.
Perhaps. Again. Thank you so much. Thank you.
Perhaps. Thank you very much. And goodbye, everybody.
Have a good week, everyone.